Central banks are some of the most powerful institutions quietly shaping our lives. Yet most of us never really notice them. They rarely appear in the headlines. They don't compete in elections, and most people don't fully understand what they do. But the truth is, they determine the value of the money in your pocket, the state of the economy, and the worth of your savings. They can create wealth in an instant, or wipe it all away. And the strangest part, they don't have to answer to anyone. This story explains how central banks became the invisible yet powerful managers of modern finance. They often appear neutral, but in reality, they are the most influential players in a game whose rules they themselves set. This is the story of the forces behind the scenes and the grand illusion offered under the name of stability. Once you understand this, you will never look at your salary, debts, and savings the same way again. Our story begins in 1694. At that time, England was virtually out of money. The war against France had drained the treasury completely. At that moment, a group of wealthy merchants made an offer to the government. "We will lend you £1.2 million. In return, give us the right to establish a bank," they said. The bank would have the privilege of issuing paper money backed by the state's debt. This is how the Bank of England was born. But this bank was nothing like the banks we think of today. Its purpose wasn't to serve citizens. It was to finance the state and make money. Modern central banking was born this way, not as a stabilizer, but as a structure enabling government borrowing. And over time, this power grew exponentially. By the next century, central banks across Europe had formed similar institutions. Most were private partnerships with special privileges. They issued money, managed reserves, and rescued governments during crises. In return, they gained immense influence. Often there was almost no democratic oversight. In the United States, things were even more contentious. Americans had always approached central financial power with suspicion. The first two central banks were closed due to corruption and elitism controversies. Throughout the 19th century, the U.S. had no central bank. The financial system was a chaotic environment of private currencies, speculative bubbles, and panics. Then came the panic of 1907. The crisis was so severe that the famous banker J.P. Morgan had to personally intervene with his own funds to stabilize the market. Pressure mounted, and in 1913, Congress passed the Federal Reserve Act. The Federal Reserve System was established. It was presented as a more decentralized structure that would stabilize the economy. But in practice, it became a central authority with enormous power over interest rates, credit flows, and money supply. The Federal Reserve is not a government institution. It is an independent organization with both public and private components. Its board is appointed by the president, but member banks are privately owned. It is funded not by taxes, but by interest on government debt and fees charged to banks. It operates in the shadows of financial markets. Its decisions affect millions of lives, yet they are not determined by public vote. Officially, the Fed has two main mandates: to maximize employment and stabilize prices. But behind the scenes, its actions often align closely with the interests of the financial sector. Consider the 2008 crisis. The Fed didn't just cut interest rates. It created trillions of dollars, rescued investment banks, supported asset prices, and guaranteed toxic debts. The same happened during the 2020 pandemic. It bought corporate bonds, injected liquidity into markets, and pushed up asset prices. In this process, the wealthy became wealthier, while others were left to wait. Central banks don't just manage the economy. They shape it. They decide the winners and the losers. When interest rates fall, stock markets rise. When rates rise, working people face higher rent and credit costs. Even claiming independence, central banks are deeply intertwined with the financial system. Their executives frequently rotate with major investment banks. Their policies often move in line with Wall Street's expectations, and their language, technical and complex, makes it hard for the public to question them. Today, central banks are more powerful than ever and answerable to almost no one. The Fed, the European Central Bank, the Bank of Japan, the Bank of England. They are not neutral observers. They are the architects of our monetary system and have reshaped the economy since 2008. Low interest rates have become nearly normal. Quantitative easing has become routine. They printed trillions to buy government bonds, corporate debt, and mortgage-backed securities. The result? Asset prices skyrocketed. Stocks, real estate, commodities. If you owned assets, it felt like a golden age. If you didn't, the cost of living soared. Buying a home became harder, and savings yielded almost nothing. Most people looked for the cause in the wrong places: politicians, immigrants, or bad luck. But the real driver was monetary policy. Today's financial system is designed not to free you, but to keep you constantly moving. Central banks encourage consumption, reward debt, and punish savings. They manipulate interest rates, intervene in markets, and move trillions at the push of a button. And all this is done under the name of stability. But the stability they protect isn't yours, it's the system's. In 2020, during COVID, markets experienced the fastest crash in history. The Fed injected over $3 trillion in liquidity within weeks. Markets rebounded quickly and billionaires' wealth soared, but millions lost jobs, small businesses closed, and renters faced eviction. What was rescued wasn't the real economy, it was the illusion of strength. When central banks distort the price of money, they distort the price of life. Risk calculations become harder, saving becomes nearly impossible, retirement plans derail. Bubbles grow, crashes hit hard. One day, seemingly solid wealth can vanish overnight. People's sense of control over their lives weakens. Most don't even realize it. Student loan interest, low savings returns, rent. All shaped by hidden decisions. Who controls central banks? Officially, they are independent. In reality, they serve the financial ecosystem, banks, markets, and the capital class. The revolving door between Wall Street and central banking is real, and the technical, complex language ensures outsiders stay excluded. But now you are no longer outside. Understanding the system turns you into someone who can see the rules, even if you aren't in the game. Financial literacy is not just budgeting or investing. It's understanding power dynamics, knowing money is not neutral, inflation is not fate, and interest rates are political choices. True freedom comes from understanding the system and avoiding its traps. This can mean owning non-printable assets, generating income independent of debt cycles, or abandoning the idea that prosperity is measured only by growth. Debt-fueled growth is like a treadmill. The faster it goes, the harder it is to stop. What can you do? Start by seeing clearly. Central banks are not gods, they are powerful players. Their interest rate decisions, liquidity injections, and asset purchases are not designed for your freedom, but to protect the system. You can't fight it head-on, but you can position yourself to protect yourself. Diversify your savings, simplify your spending, reduce your debt, and hold valuable assets. Learn how money works, teach others, question what you were told. Because the next crisis, and it will come, the central bank will do the same thing again. Protect the system. Protecting yourself is up to you. History doesn't repeat exactly, but ignoring it can hurt. If this gave you a new perspective, subscribe. The answers lie in history. I will show you where to look.